Welcome to the webinar. We'll get started shortly. Before we begin, here's how to earn CPE credit. Unlike traditional CPE webinars, there are no polling questions or attendance checks during the presentation. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz in the Earmark app. Search for the free Earmark app from the App Store or Google Play Store, or scan the QR code on the screen. Open the app and create an account. Be sure to use a valid email address because we'll email you your CPE certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. If you don't see the quiz yet, don't worry. We'll email you when the quiz is available. Complete the quiz to earn your CPE certificate. If you have questions or need help, email us anytime at support@earmarkcpe.com. Now, on to the webinar.
Hello and welcome to today's webinar, Renewable Energy Tax Credits, an accountant's guide to navigating ITCs and PTCs. My name is Joel from the Earmark team, and if you have any questions or concerns, please use the comment section. And with that, I will turn it over to Randy for today's webinar.
Joel, thank you. Appreciate it. Excited to be here today to talk about a very exciting topic. These credits are pretty amazing. We'll get into that as we talk about them today, but let's get into intros. First, my name is Randy Crabtree. I will be presenting along with Barry Devine today. This is just as a little side note, I do have a podcast called Unique CPA that is also on Earmark. So if you want to get CPE for that, you can do that on Earmark here as well. There's some information about me. Here's Barry Devine. I'll let Barry do a quick intro of himself.
Thank you, Randy. Yeah, very exciting topic here. After establishing research and development tax credit and cost seg and some other energy related services, with the passing of the Inflation Reduction Act is going to be the main point we're talking about today. So just excited to talk about this new area that we're performing services in.
And just so everybody knows, Barry does head up this program for Tri-Merit.
Yeah.
And then this is just who we are. Tri-Merit's a firm that I co-founded 17 years ago. We do all kinds of specialty tax. All credits and incentives is what we do. So today, right to the meat of it, we're going to talk about majority is renewable energy tax credits. Why I have these other things up there, the cost seg 178D, R&D 45L, because I'll probably interweave some of those into the discussion today. Because when we identify, or when you identify, or together we identify a renewable energy tax credit opportunity, it's usually not a standalone opportunity. There's usually something else that you will identify just from the nature of this credit. It ties in with a lot of other opportunities. So you as the advisor, you as the tax advisor, you can have multiple things, multiple items, multiple tax saving opportunities you can take to your clients in one bundled package. So jump right into renewable then. That's the first thing. That's where we're going to spend most of the time. Renewable energy tax credits were defined in the Inflation Reduction Act, which was August of 22. Most of these kicked in at the beginning of 23. There has been some changes, there's been some enhancements, and there's been some new credits that defined. But ITC and PTC, what does that mean? ITC is investment tax credits. It's just a certain way to qualify for these potential credits. And PTC is a production tax credit. So obviously it's for producing something, energy or maybe products that go into renewable energy. And we'll talk about 4 specific new or extended or enhanced credits that are general business credits, Form 3800, where all the general business credits go. The 4 that we're going to concentrate on today are 45, which is a PTC, and I'll define these further when we get to that section. 48, which is an ITC. 48C, which is a really interesting area, short life, but it's significant dollars available. An ITC, and then the advanced 45X, the advanced manufacturing production credit, which is a PTC. So we're going to do 2 of each today. And there are others out there. These are the main ones that we're concentrating on right now, but there's a lot of things that fall within those. Let's give a little background on what this is and why this is exciting. First off, when this was defined in the Inflation Reduction Act, the idea was to help us put incentives out there that we can start relying more on renewable energy, help the economy, help the environment, help businesses. So this is a business credit as well. We're putting incentives out there for hiring as well, and for fair wages that are tied to some of these credits as well. But without this incentive, without this tax bill that came out again a year and a half ago, it was a projection that we would, by the year 2050, maybe if you look at the no IRA on the middle of the screen there, we were going to be close to maybe 30% reliant on renewable energy. And I think it was more in the 20% range. So no incentives, not as much increase in the reliance on renewable energy, but still a significant increase from where it was in 2022. Going from whatever that is to 10 to 15% up to 25 to 30%. With these incentives that were put in this bill, we've gone from that projection of 25, 30% reliant on renewable energy to a point of time where we're 55, 60% is the projection by the year 2025. So in the next 27 years, we are projected to be relying more than half of our electricity being generated from renewable energy. And that's because of the significant volume of potential benefits that were defined in this act. This, and just to give you an idea of the magnitude of the opportunity, when we look at tax bills, Congress looks at a tax bill and they define the cost of that bill. We're, as tax advisor on the other side, we look at the opportunity from that tax bill. What are the tax saving opportunities? Many of you are probably familiar with the research and development tax credit, the R&D tax credit. Some people call it the R&E, or research and experimentation tax credit. But that credit's a significant benefit. And some of these items will tie into research and development tax credits too. But that's projected, the R&D tax credit is projected to be a $100 billion tax saving opportunity over the next 10 years. That's big numbers, 100 billion. Compare it with this. The renewable energy tax credits that were defined in the Inflation Reduction Act were originally projected from a Congress standpoint to be a cost of 400 billion. So already 4 times what the R&D projection was. Almost immediately, when some outside companies, think tanks looked at this and saw the opportunity, they already upped that to this is $800 billion tax saving opportunity over the next 10 years. And almost immediately after that, it's gone. The projections have gone over $1 trillion. So it is currently projected to be 10 times the tax saving opportunity that the R&D tax credit. So just to put it in perspective, this is not a small deal. This is a very significant credit out there. And as you see in a second, this is not just a credit for, big business or anything like that. The entities that can qualify from this, and Barry's going to expand on this a lot later in the presentation, but the entities that can qualify to take advantage of this are pretty much any entity out there. We're not talking individual. There are individual incentives out there for putting solar panel on your house and for electric vehicles and that. We're not talking that level. Today we're talking business tax saving opportunities, but not only businesses, tax exempt organizations. So Barry will expand on this, but bottom line is, if you're a business, whether you're paying taxes or not, you could take advantage of this, even if you're not paying taxes. If you're a tax exempt organization that can qualify for this, you can take advantage of this as basically turn it into a refundable credit. And so that's why this is exciting. That's why there's a lot of opportunity. And we are at if you look at the hockey stick growth curve, we are at the blade of the stick right now. We're seeing, some significant investments in renewable energy, but we are about to turn that corner and go straight up the shaft of that stick, because it is unbelievable the amount of investment that is going on into these areas. Let's get into the first one then. getting excited there because there is a lot of opportunity and a lot of tax saving opportunity, even for non-tax paying entities. First one, 45, code section 45. This is a production tax credit. This credit is available for entities that are producing and selling renewable energy. They're not using it, but they're producing and selling. And so what type of products qualify as renewable energy, just in general? Wind. We all know wind. We all know solar. There's closed loop biomass. There's open loop biomass, which is using livestock waste or the closed loop plant material grown as fuel. Geothermal, I think we're familiar with that. Irrigation, we're familiar with. You could see maybe municipalities taking, solid waste or landfills and somehow turning that into renewable power, hydro power, excuse me, and marine type hydrokinetic stuff. So there's a lot of opportunities, and you're going to see these opportunities grow. You're going to see a lot of innovation come into this area. And so just to give you an idea, somebody that's producing and selling renewable energy, when you drive, in the middle of, farmland or something, and all of a sudden you see all these windmills, that's somebody that's producing renewable energy and selling that. Or I just did a big trip heading west, and I saw, as I went through Arizona a week or so ago, a big fields of solar panels. That solar panel field is producing renewable energy and then selling that renewable energy. That's who is targeted with this code section 45 credit. So let's talk about the rules then for this. This is a production tax credit. Production tax credits are not as easy to estimate the value. When we talk about the investment tax credits, we're going to have a mindset of thinking of a 30% credit based on the dollars invested into that product. Investment tax credit, dollars invested into that product. We're going to talk about the fact how that can get as high as 70%. It can be as low as 6% as well, but 30% is probably a good mindset to think about when we're thinking about these credits. So if you use a 30% mindset when we're talking about the production tax credit, it's probably okay. It's just harder to tell you the math because it's based on units produced and all that. Bottom line is the credit's a significant dollar amount. Now, this is actually going to start at a 6% credit. But if we meet certain requirements, it'll get up. I mean, it's not 6% credit. You see the 0.003 kilowatt per hour credit. That can be adjusted 5 times up if we meet certain criteria, which we'll talk about a little later. A production tax credit is not a one-time thing. It's over a length of period thing. And in this scenario, it's 10 years from the date placed in service. So we just put a new solar panel array out where we're producing energy and we're going to sell that energy for a 10-year period from when we put that placed in service date is when we could take advantage of a production tax credit. Now, what I wanted to let you know is if you qualify for an investment tax credit and a production tax credit, you cannot take both. So you as the advisor have a decision to make. You have to look at the opportunities out there and see what makes sense for your client. An investment tax credit is a one-time deal. We invested dollars, we get a credit. What's the value of that? Let's assume 30% of $1 million we put in, we have a $300,000 credit. If we also qualify for a PTC, now we have to make a decision. Is this 10-year credit in the long run going to be worth more dollars than the current investment that we did? Most likely it will. And then you have to go into the decisions. Well, does the client need the money now? Can they, delay over a 10-year period getting this money? It's just something that you have to be familiar with as the advisor. Obviously, we're always available to answer any questions. But bottom line is, cannot take both. So ITC or PTC. In this scenario, we just talked about 45L. I'm not going to go into I am going to expand on them real quick. This is a specified credit, which means it can offset AMT. So if you're AMT, don't worry about it. It actually offsets AMT backwards 3 years and then forward 20 years, like most general business credits. Barry's going to expand on this, but it can be you can actually transfer this. If you can't use it, you're not paying tax. You have the transferability. And then as a nonprofit, you can turn it into a tax payment, which then just basically comes back as a refund. So that's how anybody can qualify. Again, Barry will spend more time on that. I just wanted to give you a little tease before we moved on to the next section. The next one, and this is probably where you're going to see the most opportunity. This is probably where your clients, some of your clients have already at least looked at these opportunities or installed some of these opportunities. And what this investment tax credit is, and is a credit for the dollars we invested in an entity that's going to produce and use the renewable energy. So this is a manufacturing facility that puts solar panels on the roof, and they're going to use that solar panel power, to charge the batteries that then they're going to use to help run their facility. So 48 is for producers and users of renewable energy. So independent businesses, and are going to be using this. Again, the new items that were defined in the Inflation Reduction Act, you see here the first 5 there, but battery storage, obviously that's important. I'm sure everybody knows this, but when the sun's out and it's producing power, if the sun's not out, it's not producing power. What the solar panels do is they store that power in the battery. So batteries are important. And so they've put incentives on there now to put battery usage into areas, microgrid controllers, interconnected property, qualified biogas property, this is the last one. This is electrochromatic glass. This is pretty interesting. What you're going to see is, maybe office buildings putting this special glass on the outside of the building, replacing the current windows, and this actually creates power. And so this is an area where you're going to see, businesses, especially maybe, office buildings, starting to use more renewable energy, and then solar power and all fiber light, all this stuff we've seen before. These are the types of products that can generate renewable energy. This is now the credit where we're going to start thinking it's a 30% of our investment. This actually starts as a 6% credit. It can get that 5 times benefit if we meet a couple of criteria. One is this prevailing wage and apprenticeship requirements that we've been hearing about. But another one is if we meet a certain requirement of energy production. If we meet that and stay under a certain level, we can get to a 30% credit. And so most businesses, let's look at this as a square footage of a building. If we have somebody that puts solar panels on a 70,000 square foot rooftop, which is a fairly large rooftop, there's a good chance, just based on the output that generates, that's already going to generate a 30% credit. So that's why I think the mindset of thinking 30% credit is a good place to start, but always understand that the 6% credit is the starting point. Now, 6% credit is great, but it doesn't get me all that excited. A 30 to 70% credit based on some potential bonuses we might be able to get, that gets me excited. And that's why this is an area where you're going to see a lot of adoption. Again, specified credit offset AMT, again, turn it into a tax payment for a nonprofit, and again, it's transferable. This has to be depreciable property. It's fixed assets we're putting in, and that's important. It has to be completed by the owner for the original use of this, for them to be able to take the credit. But if we do meet all the requirements, you're going to see a lot of investments being put into this, because the break-even points comes down so low. You're going to get such a big significant portion of your investment back so quickly, and then over time you're going to save all those dollars you would have spent on paying the power company, that you're going to, at some cases we projected that within a 5-year period companies are going to have their investment returned, and then it's all free money after that. So that's code section 48. We talked about the requirements to get into 30%. If the output is less than 1 megawatt, that's an automatic to get to a 30% credit. If you meet and you've heard this term, the prevailing wage and apprenticeship rules. If you meet those, and there is a website where you can find out if you're meeting those or what the prevailing wage is in this area, you can then get to the 30. And this isn't either or. This isn't hit all three of these. Or if you had 5% of the construction completed by January 29th of 2023. If we had that, then we automatically get to the 30%. And the reason they did that is because they didn't define the prevailing wage and apprenticeship rules until about that time, but they had defined this ITC before that. And so if people jumped on it and said, I'm going to start investing money in this, they gave them almost a free pass. Okay, you don't have to meet the prevailing wage and apprenticeship rules if you started before we defined those rules and at least 5% of the construction was completed. And so that's the three different ways we can get to the 30. I think the next slide we'll talk about bonuses that we can get to up and above 30. But be aware when we're talking about the wage and apprenticeship rules, that is the user, the person that takes, the entity that takes the tax credit is the one that is required to substantiate that, yes, we met those rules. And if you don't, the penalties could be significantly high. So make sure you're aware of that. Make sure you talk to somebody that can analyze that for you, because you as the user of the credit are the one that is liable if it is found that you did not meet apprenticeship rules and you took a 30% credit based on that. All right, I'm not going to spend a lot of time on that. That's just something you need to be aware of. We talked about the fact that there's a 30%, 6% credit can get to 30% fairly easily. In my mind, a lot of our clients will get there. Now, how do we get even further than that? There's a bonus out there if it's called the domestic content bonus. And so what this is saying is if we are using at least 40% of domestically produced products and materials, then we get a 10% bonus. So now all of a sudden our 30% bonus went to a 40% bonus. If we are doing this project in what's defined as an energy community, so an energy community is a brownfield site or an area that had significant employment related to coal or gas, and the unemployment rate is above the national average, or these are all ors, or we're in an area that which a coal mine closed after 1999. So if we meet one of those criteria, or coal-fired electric generating unit was retired after 2009, if we meet one of those criteria, we get another 10. We don't get, if we hit 2 or 3 of them, we don't get 10 for each. If we hit one of those, we get another 10% bonus. So now the potential is, an additional, it's gone from 40 to 50 if we met the first two. And then there's a third bonus defined, and it's either a 10 or 20%. I'm not going to go into criteria, but if you are in what they consider a low-income community, if you're doing this project in a low-income community, there's a potential additional 10 or 20% credit. And again, when we're talking these percentages, we're talking the percentage of the investment that we put into this, the qualified investment, and we'll talk about qualified investment shortly, but the qualified investment tax credit that we put into these projects. And so if we have $1 million of qualified investment and we meet all these criteria to the max, now it's not going to be that common, but let's assume we did in a scenario. We file our tax return, we have $700,000 of a tax credit available to offset income tax, offset AMT, and as Barry will talk about, is transferable. So even if we can't use it on our own tax return, we can get money by selling this credit. And so that's why this can get super exciting. The investment comes back so quickly, and then the dollars on saving energy usage are so significant in the future that the credits are very well. All right, I keep teasing Barry. I'm going to hand this over to Barry now and let him go into his area that he is extremely excited about.
I am extremely excited. Thank you, Randy. Earlier, Randy said he's trying to show like the magnitude of the opportunity, right? Like $1 trillion in tax spend. So what are the dollars in the actual dollars being spent? Well, they're 6 or 30% of $1 trillion. So it's a lot of money. But I think the intent of Congress was we want these entities, and we want people to actually pull the trigger. we want you to actually do renewable. So tax credits are great for those who pay tax, right, or have tax. And so the pool was smaller of who would actually pull the trigger. So what they did is they did focus on the usability of the tax credit. That is, how do you utilize, these credits? So two avenues, two channels here. One is there is a tax credit for, so unfortunately my slides have a lot of words on them, but these are Cliff's notes you could take away to read these after you have the slides. But so under code section 6417, what they said was, if you're tax exempt, state, state authority, Indian tribal government, any non-tax paying entity, you get a refundable credit. Well, I'll show you how that works. You file this 990T. You say that you have a tax payment. The government recognizes you as not for tax, a non-tax paying entity, and they write you a check. So what the previous slide that had universities and churches and schools and municipalities, all on the right side over here, all of these entities can now take advantage of tax credits, which is just phenomenal. So on the other side of the equation, if you're a for tax entity, right, your manufacturers and food processors and breweries, whoever it might be, you're paying tax, you get your credit. Well, then you have two options. You can either use your credit, like Randy said, you go back 3 years, 2 years, 1 year, current year, carries forward for 22 years. So you can either use your tax credit, or under code section 6418, what they call transferability, you can sell it. If you got an unrelated party, sell your credit for cash. So on the next slide, this is going to be for the elective pay, the not-for-profits. There is the IRS has regulations. These are proposed regs. Last Thursday, the regs for 6417 became final. So we do have final regs for any non-tax paying entity, tax exempt organizations that want to make what's called elective pay. They go into the IRS portal, make elective pay, get a refund. So these are just the steps that the IRS laid out and how to do it. Again, here's just your Cliff notes on what the process is. Next slide, Randy. There should be, so for what they did is they have the IRA, the Inflation Reduction Act, and the CHIPS Act, right? So both of these have a portal that you have to register with the IRS, right? So it'll say IRA and CHIPS Act. There's a pre-filing registration where you go in, you put your entity, you put your bank account information, you get registered with this eco account, like this ID and me. You go in there and you register first, and then the IRS recognizes you, and then they say, okay, you're either going to be a T, which means you're a taxpayer and you want to transfer, or you're a P, which means you're not your non-taxpaying entity and you want to choose elective pay. So again, some of these are some takeaways. If you need help with this portal, the IRS just published extended hours for individuals, either tax-paying or non-tax-paying entities, to go in and get help with this process in order to be able to make these elections. So applicable entity, eligible taxpayer, registrant, there's just a little bit of definition here to help people understand how this actually works. So the next slide, Randy. So this is, if you're doing elective pay, you earn a credit, right? So there's a little box here that says if you're 48, you're going to use the 3468. If you're doing any of these other tax credits, whether it's an ITC or a PTC, they're going to follow the same rules. One, like Randy explained, you're going to spend that $1 million and you're going to have that 300,000 in the year that I place in service. That's for the ITCs. The PTCs, you're going to place in service, you're going to generate the energy, you're going to sell it, you're going to have a number at the end of the year. Either way, they're both going to follow the same process. So you're going to submit your registration. There'll be 5 quick steps with that eco account. And then you're going to go in this holding pattern where the IRS is like, okay, account lockout, awaiting assignment, under review. They're going to give you some type of kind of correspondence notification. And here it'll have your general information, credit specific. And they say, okay, you're registered. Now, please wait, because we're going to process your registration. And then what you'll do is once they say, okay, we have you recognized, then there'll be a form 3800, which is interesting because It's a general business tax credit form. So on the tax side, they may understand what a 3800 is. On the not-for-profit side, that's going to be a new form because it has to do with credits. But anyway, it is one of the mechanisms of how you create the credit, flow it up 3800. Whether you're for-profit or not-for-profit, you're going to submit that form, and that's how you're going to get your credit. If you're not-for-profit, they're going to send you a check. If you're for-profit, you're going to have a number, a registration number, find a buyer for your credit, make a transaction, and you get the cash. So that's just an overview of how that works. Next slide. I think this is just a couple of snapshots of screenshots of what it looks like when you're in the portal. You'll have to know, what credit you're choosing. What is the program? Is it advanced manufacturing? Is it 45X? Is it 48C? Like, what credit are we talking about? The list of credits that Randy previously showed, they show up in this fancy portal here, all organized and ready for you to choose one. And then a note is, here's the facility or property. So there's actually two kinds of credits. One is a property, like I have solar panels, that's my property. I have wind, or I have a credit on my facility. Two really cool programs Randy's going to talk about in a minute that are for, the actual processing and supply chain and all that stuff. So that's just a little snapshot of what the portal looks like. Next slide. So that was the kind of the elective pay process. And for the transferability, it looks exactly the same in the portal, just different when it comes to buyer and seller. But this will be, they say there's 11 credits eligible to sell, but just that first bullet point is section 48, which on Randy's other slide was solar, wind, geothermal, biomass. All these other credits are just in the first bullet point. And then there's the other specialty credits that are also, all of these credits are available to sell. Next slide. I think it's another picture. I tried to do as many pictures without words, but it sometimes, just takes a little bit of language to get there. So very, very high level. There's eligible property, eligible taxpayer, and eligible credit. This becomes the seller or the transferor, right? I put in wind. I have this ITC, spent $10 million. I have $3 million to sell, right? Whether that eligible credit goes to the transferee, the IRS calls the taxpayer, which is relevant because when the IRS comes to audit and take a look, guess what? They go to the buyer of these credits because they're the taxpayer. So the buyer is the transferee. They don't get to deduct the asset. There is a 5-year recapture period. If for some reason the wind stops blowing and that eligible credit property is no longer in service, there is recapture. So it's the excess credit plus a 20% penalty that the buyer will have to pay back. So in order to make the transaction, the buyer pays cash for the credit. Credit goes in the tax return. And if they're buying it, we're not going to get into exact dollar amounts, but buyers for very large PTCs, buyers are paying 90 to 96 cents on the dollar. Smaller credits or ITCs, different technologies, there's a different price on these credits, but there's somewhere 88 cents on the dollar up to 93. Smaller uninsured ITCs, nobody really knows yet because that market is yet to exist. So next slide. So electronic portal. So they transfer the 6418 regs are not final yet. So they have the proposed regs, how to do it, get in a registration number, eligible credit properties. You have to go in and put in the latitude and longitude of your asset, right? You got to go in and put all this information. And then the next slide, Brandon, this is all, Cliff Notes, take this away. So this is how to make the election. So it's very critical. If you're a seller, you go in the portal, you receive that registration number, and that is going to go with the sale. And the buyer is going to take the seller's registration number and file the tax return, because what the IRS is doing is, the IRS, after PPP and ERC, they're a little tired of fraud. So what they're doing is they're saying, we're going to tick and tie every one of these registration numbers. So we know this is a legitimate credit, legitimate property, legitimate, seller, and a legitimate buyer. So they're going to be, tracking behind the scenes. And then there is a transfer election statement that has to be made in order to make that sale. So the next slide, Randy, I think that might be it for me. Here is an update on transfer. This is the last updated January 18th. So I couldn't find any more recent data. They weren't publishing it, but it's estimated that somewhere between, and this is a very big range, between $3 and $9 billion of 2023 credits will go through the portal. So they said they had about 1,100 projects or facilities that had that were trying to either do elective pay or transferability. 110 projects pursuing direct pay. All the other ones were pursuing transferability, so going to sell their credit. So the portal came online late last year. It's working. Had a few hiccups. They're a little slow in giving registration numbers, but now it's up and running. So somewhere north of 3 billion in 2023 credits will transfer. 2024 and beyond will be in the excess of tens of billions of dollars exchanging hands. So just to come full circle on what Randy said, the magnitude of the opportunity is massive. It's just massive, where you can buy and sell these credits. It's just going to be a whole new marketplace, and the onus and the validity of that credit is on the buyer. So it's a little bit of buyer beware. Make sure you understand the credit. Make sure you have the right due diligence package, the right specialty tax. You have all the right partners and players and due diligence substantiation in place when you're going to buy a tax credit. So that's my piece on transferability. I think the next one's going to go in some examples, and so I'll turn it back over to Randy.
Thanks, Barry. Barry is a guru when it comes to this. This is he's daily excited with new information that he's sharing with our team. So thanks for that, Barry. Appreciate it. Let's go, before I go to those last two credits, let's just do a quick example so you get an idea of what the potential value is of a credit here. And as Barry said already, and I said, and we both said, I mean, you're going to see churches and nonprofits be doing this because there was no incentive for them to put solar panels on before or use a wind turbine before, because they didn't have a tax credit opportunity. Now they do, and you're going to see this. So this is not, again, I can't stress enough, you will have clients that do this. You definitely will have clients, and you may have already, and you will see the growth in this over the next couple of years too. So here's a quick example. Let's just use a biogas system. We're going to generate power from farm waste, and so we have an investment that's going into this project. In this scenario, this is just an example. In this scenario, we have a total investment of $282,000. Now, this is the first point where I'm going to tell you how this is going to tie in with something else. What we need to do almost in all of these situations is a cost segregation study, because we have to be able to identify what is 5-year energy property, because 5-year energy property is the only property that's available for the credit. In this scenario, we went in, this hypothetical scenario, we went in, we did a cost segregation study, we pulled out all the cost, we determined of the $282,000 that was invested, 240 of that was classified as 5-year energy property. And you can see, I mean, the engineering design, the permits, the equipment and installation. So a significant thing, structural for the plumbing, the generation for the electrical, a lot of these costs do become 5-year energy property. Once we identify the 5-year energy property, what does that do? Well, that's our base for determining the credit. So let's assume this is a 30% credit. In this scenario, we have a $72,000 credit. This is depreciable property. And we all know with depreciable property, obviously we write it off over so many years. Well, if this is 5-year property, that 5-year property is going to be bonus eligible. So we're going to be able to write off the rest of that cost as bonus eligible property, which as we sit right now and talk, we're in an 80% bonus for last year. Congress does have a bill in front of it in the Senate right now. The House passed it to have bonus go back up to 100%. So we're a little bit in flux, not sure what's going to happen, but at a minimum for last year, we were at 23, we were at an 80% bonus. That can change. Just obviously know the bonus rates in the year that you're looking at. So in this scenario, we have generate a 30%, a $72,000 credit. We all know when you have a credit, we have to affect something. You've all dealt with ERC. Some of you dealt with R&D. You have to reduce your expenses by the amount of the credit. Same thing here. We have to reduce our investment by not the amount of the credit. This is where this credit even gets a larger value. We only have to reduce our investment in this project by 50% of the credit. So we get an extra little kick of additional. We still get to write off half of the credit, where in most credits we don't get to do that. So in this scenario, we have to reduce our investment in the property by $36,000 when we determine what we can depreciate. And so our depreciable basis of the 240 that was qualified at 5-year energy property, our depreciable basis is 204,000. Assuming we have 100% bonus, that's going to be bonus eligible. So we're writing off 200,000. Let's just assume we're in the 30% bracket as well. That's a $60,000 tax savings there. We got a $72,000 credit. We're at 132,000 savings just on those two things alone. So we almost recouped half of our investment in that first year. That's a pretty significant dollar amount. Now, assume that we got a bonus or two. I mean, assume we got up to a 50% credit. Obviously, now we're close to $100,000 credit. Or over 100, we're $120,000 credit. We still get the depreciation. We only have to reduce that basis by half. We're going to start recouping that investment very quickly. That just gives you an example of how this works. Not only are we writing off, not only are we doing cost seg to determine what life things are, but we're getting a credit, and we have a bonus from the fact we only have to reduce our basis by 50% of the credit. Now that's on 48 only. That's the depreciable property. Let's talk about solar, because everybody knows solar. Everybody's seen solar panels before, and it's probably, at least at the beginning, going to be one of the most common. And the solar companies know this too. The solar companies, and they're out there educating as well on the opportunity for tax savings. And some of those companies we're teaming up with as well, just because they see the projects being put in place. And so let's assume somebody does solar panels. Same scenarios before, the depreciation, the bonus, everything. But what else happens? Well, when we're going to be touching the roof, because most likely these solar panels are going on the roof, we're probably doing some roof work, cost segregation opportunity. I think roof repair and replacement qualifies for 179 as well. Some of it, I think. I'm not the 179 expert. But when we're touching the roof in itself, my first thought is there's a 179D opportunity. 179D is the energy efficient commercial building deduction. That's available for anybody that's helped making their property more energy efficient through insulation, windows, roofing, electric, lighting, HVAC, one of those areas. And so if we're touching the roof, now we're looking at cost seg, we're looking at potential 179D, and we're looking at a renewable energy tax credit. So you now as the advisor have this pool of opportunities to choose from when you're doing tax planning with this client. What makes the most sense? Are we going to be able to use all these benefits? If we are getting the renewable energy, is the 179D not going to be as valuable this year? Maybe we wait on that, because there is that opportunity to take it in the current tax year based on what your situation currently is. So there's a lot of planning opportunities there. 48C, I'm going to go into this one, and we're transitioning from 48 that we just talked about. 48C, this is the one at the beginning where I said it's a short-term program, but very significant dollars coming into this. This is a program that was established a while ago. It got a bump up in the Inflation Reduction Act. It's basically credit available if we're going to be doing something to our facilities. And so this is an application process. The first application actually, and I think I have this in the slides, but let's talk about this. The first application actually was last July. So we've gone through one round of applying for that, as you see in the first line here, the $10 billion that's currently available. I think, and Barry can jump in if I'm wrong here, but I think they estimate around 4 billion maybe was accounted for. They don't know yet. There was a lot more that was asked for than the 4 billion, but I think they expect about 4 billion to be allocated in this first round of application process that happened in July. The second round, and again, Barry may know, at the end, he can correct me if I'm wrong, but I don't think that second application has popped in yet. I think we expect it to be very soon. Do you have a date on that, Barry?
Yeah, March 31st. They're supposed to announce round one.
All right, they're going to announce
which is 4 billion and 40% in designated energy communities.
Okay, so that,
Yep.
and then the second round will be then sometime after that where you'll have this application process. But
Yep.
so if you have any clients that are one of three things: re-equipping, expanding, or establishing their facilities for the production or recycling of renewable equipment, they have an option to get this 48C, this Advanced Energy Project credit. If you have a client that is re-equipping their industrial or manufacturing plant to reduce greenhouse emissions by at least 20%, that's an opportunity to qualify for 48C. Or I should say, if you have a client that is re-equipping, expanding, or establishing, sorry, I'm reading these, the manufacturing plant or recycling of critical materials or minerals, they can potentially qualify. So there's three different categories. It is a pretty significant application process. And I don't know, Barry, if you want to go through that slide at all, otherwise I can continue.
Yeah, I'll jump in. I mean, but basically two stages here in order to get an award of the money. It's a 30% credit, so that it's still similar to the 48. It's just, credit in advance. You're going to say, hey, if I spend this money and I do these certain things, can you guarantee that I'm going to get this credit? So you still get it later, but what it is the DOE partnered with the IRS, which is interesting. And so there are four pages on the concept paper. So you're gonna get the concept paper into the DOE. They're gonna review it, and they're gonna do one of two things. They're gonna give you an encouragement letter or a discouragement letter, which is a really nice way to say we don't think you should apply. But if you get an encouragement letter, what they say is, yeah, we like your clean energy manufacturing recycling, your greenhouse gas, your critical minerals. Like, we like what you're going to do. It's very heavy. Don't forget on prevailing wage and apprenticeship. What's the workforce? What's the community involvement? So they have different things they look for in your concept paper. But if you get an encouragement letter, then you do the full application process and you wait to see if you get awarded the credit or not. So
Perfect.
All right.
Perfect. So we're going to have to spend a lot of time on that, but realize that if there's questions, you can always reach out to one of us.
Yep.
But that is a significant opportunity there. And now what we just talked about, and we're going to talk about on this next one, 45X as well. And let's go back a second. If you're re-equipping your manufacturing plant, 2 and 3, and they all say that you're re-equipping your manufacturing plant to do something, you're investing in those plants. Well, what's the other thing that then pops into your mind? Almost all manufacturers do some level of research and development. And so now we've bundled renewable energy with an opportunity to look at R&D tax credits for this taxpayer as well. And obviously cost seg and other things come into play. And let's talk about the last one that we wanted to identify today, which is 45X. This is an investment tax. This is a production tax credit. I made a mistake on that slide, but it's a production, not an ITC, but it's a PTC. It's a production tax credit. And this is available to manufacturers. Again, we're thinking R&D tax credits along with production tax credits. And this is available for manufacturers if they are manufacturing eligible components that go into renewable energy products. And so solar related components, wind, this just examples, wind energy components, inverters, battery components, batteries are big, and the recycling of batteries are big too when we talked about recycling of critical minerals, but critical minerals as well. So if we're producing these products and they are ending up in a product that produces renewable energy, we as the manufacturer can now take advantage of a production tax credit. And when we say production tax credit, again, it's based on the production. So what did we produce? How many materials did we produce? How many, wind turbine blades do we produce, or inverters do we produce? And we get a credit based on that. So it's hard to define the value of that, but it's out there. We can go deeper into that at some point in time. It's more of a case by case. So we want to look at it, but it's based on the materials produced. Now, we talked about 48C, that you have the opportunity to get an investment tax credit if you're this manufacturer and you're expanding your facility. Again, I just want to reiterate, if we can qualify for the 45X and the 48C, we can't do both. We have to pick and choose which one makes the most sense for us. This one, there's an additional benefit. Not only is it, follow the 6417 and the 6418 that Barry explained. This one, and Barry can confirm this as well, is eligible for a for-profit to turn it into a refundable tax credit. Is that correct, Barry?
That's correct.
So
Yep.
this is one where if you're an entity that is not paying tax and you can do the elect to payment or whatever this is called and turn this into a refundable tax credit. So this is a pretty significant benefit out there as well. And anything you want to add on that, Barry?
It's a very lucrative credit. I mean, I think it's like 17 cents a kilowatt hour. So it's a very lucrative credit. There's different price per unit when you look at the 7202 form. But it's very lucrative. And I think it's the government's way of saying we're very serious about the supply chain. Like, we have an issue. So if you can make these, you will benefit. It's a lucrative credit. So they're serious about supply chain, and you can see it in this program.
Yeah, this and the chips both. Supply chain was a big deal. And Barry mentioned that before, and I think that's great to reiterate, is the fact that these tax bills are out to do additional things besides just a tax credit. It is looking to stimulate the economy as well by keeping these type of manufacturing activities in the U.S. All right, I could put a quick list of these interplays between everything else. After this, and you all, I've been told, will have access to the slide deck. So I have slides in here that's going to talk about all four of these areas as well. So you could look at those deeper. But we already talked about the fact of cost segregation is going to come into play almost always when you're looking at renewable energy, because we have to identify what qualifies as 5-year property. And cost seg is simply is just identifying components within a improvement that qualify for whatever lifespan that meets in the IRS code. 179D is for commercial buildings. Anything, we expanded on that before, but anything that we're doing that is going to make our building more energy efficient could potentially qualify. 45L is a credit for developers of energy efficient residential homes, but when we have mixed use property, that can interplay with the credit again. Maybe we're generating power in our mixed use property as well. So 45L, that credit available for developers, and then the R&D tax credit. A lot of this you saw already tied is in with manufacturers, the facilities, the manufacturings of the products. And so just be aware of those are the four main ones that I see the interaction from, but there'll be others as well. And with that being said, I'm not going to go into the other slides, but let everybody know that they're there. And Joel, I will hand this back to you to wrap up.
Thank you, Randy and Barry, for hosting today's webinar. And with that, I will turn it over to Blake to explain how to get CPE.
Today's webinar has ended. We hope you enjoyed it. To earn CPE for watching, download the free Earmark app. Scan the QR code on the screen to visit the download page. Open the app and create your account. Use a valid email address where you will receive CPE certificates. Then register for the course. You can search for it by tapping on the magnifying glass icon on the home screen and then entering the name of this webinar. If you're attending the live stream of this webinar, keep an eye out for an email letting you know when the quiz is available in the next few days. Pass the quiz to earn your CPE credits, then tap the button to email yourself a CPE certificate. Stay tuned for more webinars from Earmark. We appreciate you joining us today, and we look forward to seeing you again soon.